Imagine watching the economy collapse. Not slowly, but all at once. Banks failing, businesses shutting down, millions of people losing everything, and it all seems to come from nowhere. That's how most people understand the Great Depression. A sudden disaster, a market crash, a moment in history where everything just broke. But that's not really what happened, because the collapse didn't start with chaos. It started with a decision. In fact, if you go back to the months before the crash, the system didn't look broken at all. It looked unstoppable. The 1920s were booming. Stock prices were rising. People were making money. Confidence was everywhere. Ordinary people weren't just saving anymore. They were investing, borrowing money just to buy stocks. And for a while, it worked. Because as long as prices kept rising, everyone felt richer. But underneath that growth, something was building. Debt, leverage, risk stacked on top of risk. Millions of investors were buying stocks with borrowed money, pushing prices higher and higher until the system became unstable. And this is where things start to shift. Because when a system is that fragile, it doesn't take much to break it. Not a war, not a collapse. Just one move in the wrong direction. In 1929, that move came quietly. An attempt to slow things down, to cool off speculation, to bring the system back under control. But instead, it did the opposite. Because when confidence is everything, even a small shift can change how people think. Investors started to hesitate. Prices stopped rising. And once that happened, the entire system began to unwind. Because if you're holding assets built on borrowed money, and prices stop going up, you don't wait, you sell. And when everyone tries to sell at the same time, there's no one left to buy. That's when the panic begins. And within days, the market didn't just fall, it collapsed. Over the course of just a few days in October 1929, stock prices dropped dramatically, wiping out huge amounts of wealth and triggering widespread panic. But here's the part most people never question. Why did it collapse so fast? And more importantly, why did a single decision have the power to trigger something this big? Because the crash wasn't the real story. The real story is what that decision exposed, about the system itself.
So what was the decision that helped turn a booming economy into a collapse? It came from the institution that sits at the center of the financial system, the Federal Reserve. At the time, the economy was overheating. Stock prices were rising rapidly. Speculation was everywhere. And more people were borrowing money just to invest. From the outside, it looked like growth, but underneath, it was becoming unstable. So the Federal Reserve stepped in, not to crash the market, but to slow it down. They raised interest rates. Now, on the surface, that sounds like a small adjustment, just a technical move. But in a system built on borrowing, it changes everything. Because when interest rates rise, borrowing becomes more expensive. And when borrowing becomes more expensive, the flow of money starts to slow. The same investors who were using cheap loans to buy stocks suddenly had to think twice. Some stopped buying, others started selling. And that shift, from confidence to hesitation, is where things begin to unravel. Because the market wasn't just built on real value, it was built on expectations. As long as prices kept rising, the system held together. But once prices stopped climbing, the logic flipped. If you're holding stocks bought with borrowed money, and the price starts to fall, you don't wait, you sell. And when enough people do that at the same time, prices fall even faster, which triggers more selling, more panic, more pressure on the system. And this is where leverage becomes dangerous. Because many investors weren't just using their own money, they were using margin, which means if prices dropped too far, they would be forced to sell, whether they wanted to or not. These are called margin calls, and once they begin, they accelerate everything. Because now it's not just fear driving the market down, it's the structure of the system itself. Forced selling, falling prices, more forced selling, a chain reaction. And the Federal Reserve's decision, raising interest rates, didn't cause all of this on its own, but it changed the conditions. It removed the fuel that had been keeping the system going. Cheap money disappeared, confidence weakened, and once that shift happened, the system couldn't hold itself up anymore. What followed wasn't just a correction, it was a collapse. And here's where the story becomes even more important, because the crash itself was only the beginning. Banks began to fail, credit dried up, businesses couldn't survive without access to money, and as the system tightened, the effects spread, from Wall Street to the real economy. Jobs disappeared, production slowed, confidence vanished completely. And what started as a financial problem turned into a global crisis. But here's the key point. It wasn't just bad luck. It wasn't just panic. It was a system that had become too dependent on one condition: cheap money. And the moment that condition changed, everything began to fall apart. Which leads to a bigger question. If one decision could trigger a collapse like this, what does that say about the system itself? So if one decision helped trigger the collapse, what does that actually tell us? Because the Great Depression wasn't just a historical accident. It wasn't just panic or bad timing. It exposed something deeper, that the system itself was fragile. Not because it was broken, but because it was built on conditions that couldn't last forever. Cheap money, rising prices, constant confidence. As long as those things stayed in place, the system looked strong. But the moment one of them changed, everything started to unwind. And that's the part that matters. Because the decision to raise interest rates didn't create the risk, it revealed it. It exposed how dependent the entire system had become on easy money and rising markets. And once that support was removed, there was nothing holding it up. What followed wasn't just a market crash. It was a chain reaction that spread through banks, businesses, and entire economies. And suddenly, something that started on Wall Street was affecting millions of people who had never bought a single stock. That's when a financial problem becomes something bigger, a system-wide collapse. And this is where the story stops being about the past and starts becoming relevant again. Because the structure hasn't really changed. Markets are still driven by confidence. Economies still depend on credit. And central banks still influence everything through interest rates. The tools are more advanced now. The system is more complex. But the foundation is the same, which means the same pattern still exists. When money is cheap, risk builds. When conditions change, that risk gets exposed. And when confidence disappears, things can move very quickly. So the real lesson isn't just about what happened in 1929, it's about understanding how systems behave when they rely too heavily on one condition. Because it's never the boom that causes the collapse. It's what the boom is built on. And once you start to see that, you realize something important. The Great Depression wasn't just a moment in history, It was a warning about how quickly things can change when the system shifts beneath you. This is Empire Economics, where we break down the systems shaping your world one story at a time. And once you see it, you can't unsee it. Thanks for watching.